So first, it's a pleasure to be here. I graduated in 2003, so took the class was Berlin back in 2001 with Professor Gültekin, and it was one of the great classes, one of the few binders that I keep in my office and I refer to from the Wharton School because I found it very practical and useful. So I still use it. So it's a pleasure to be here. I would just want to give you today, and you read the case. I hope I didn't bore you with that one. We didn't bore you. It was a case that real life story, basically a real deal that happened with us at Amwal. But before just delving into the case, just to understand, how many of you have worked in private equity before? If you may raise your hand just to understand. Okay. And how many of you would like to work in private equity? Everybody. Okay. We have one opening. I'm just kidding. Did any of you considering emerging market, and specifically I would say the Middle East? Okay, we're going to try to make it as relevant as possible. So I would just want to give you a bit of introduction of what Amwal Khalij is about. It's not an easy name to pronounce, that's for sure. So it's a private equity firm that was born in Saudi Arabia in end of 2004, early 2005. It's a private equity firm focused really on deploying funds in the Middle East and North Africa. It's not leveraging, I would say, the capital base of the region to deploy outside like InvestCorp when they started. So we're very MENA-centric. And when we say MENA, we say Middle East, North Africa. And for Amwal, that definition is very specific because some of them went to include Pakistan and India, for example, went to include Turkey. But for us, we decided to be a bit more centric. And when we say Middle East, North Africa, we do focus a lot on Egypt, on the UAE, on Saudi, and on the Levant countries, which is like Lebanon, Jordan, and few of the other surrounding countries. So we have offices in Riyadh. This is where the headquarters. We have an office in Cairo, and we have another office in Dubai. We have about 15 investment professionals. All of us are from the region, so indigenous. I would say the background is very much like many of you, so either investment bankers or consultant or ex-industry people that have, most of them as well, an MBA or business education background, a CFA or something like that, and went back to the region and working in private equity. So Amwal is focused very much on growth capital. So we're not the typical buyout firm that you would find in the West. So it's a very much growth capital, very adjusted to the region's, I would say, dynamic, because it's not a region that's very, I would say, short of capital, at least for a point of time. And the evolution of the private equity in this region is very, I would say, at its first stage. I would not say immature, but I would say this is where like Germany was in the 70s, or in the US was even maybe earlier. So we buy into companies, we don't buy out companies, and that's something important. We're always making comparison of like if you were to buy a company, and the company being the horse, well, we buy the horse and we buy the jockey. So we buy management and company together. So we do not bet on companies without the right jockey on it, because the race for us is not a race that you can win alone by just replacing any jockey on the horse. So that's basically one of the premise of Amwal. We have about $700 million under management. We started with the first fund, was very centric on 3 families, let's say the money of 3 large families in the region. The second one had about 9 or 10 families. Most of them, I would say, high net worth individuals, but pretty sophisticated investors. They also invested like in the who's who of private equity funds, whether it's Carlyle or the InvestCorp of the world. So very familiar families. And the typical investment ticket is about $25 to $30 million in the fund. So it's not a small ticket. They're not like the passive typical LP. They're much more of a, I would say, active partner, because we do leverage a lot the presence and the reputation, the credibility of these partners in our part of the world. So in the second fund, we had about 10 LPs. We had one institutional. Was a big learning for us. We got the special situation group of Goldman Sachs that became the second largest LP in the fund. At the time, they were thinking about coming more strongly into the region and investing and deploying capital in the region in partnership with, I would say, a local fund and so on. And we were privileged enough to capture this, I would say, capital base that they allocated for the region as Amwal. So I would say that's a bit of Amwal Khalij, what we do. So when we say growth capital, what do we mean by that? we are basically a company, as I said, that buy into companies. So the ideal transaction for us would be to come in, deploy capital into a company, expand it, take it further, whether make it from a regional company to a national one, national to a regional one, and improve that company. Corporate governance, institutionalization of the governance and the processes internally, and also, I would say, expansion of the business, whether into new businesses, vertical, horizontal integration, or geographic expansion. So this is basically what you provide. You also provide liquidity events. You're there to help these companies go public. Let's not forget that this region is about private businesses. It's not an economy where the public market basically is, the public companies basically are dominating the industries. 95%, as a matter of fact, of the Saudi business, for the Saudi Arabia is made of family businesses and private businesses. So you are buying into companies, into families. You're being invited to boards of companies that have been run by families for the past 50, 60, 70 years. So you're a newcomer into this market. So you come in, you buy into this company. We typically buy sizable minority, and that does come with its challenges. It's not a straight, I would say, buyout where you take control. So you come in with the blessing of someone, of a family, and you have all kind of dynamics that you have to work around. We typically also require active board seats, sit on the executive committees of certain initiatives in the company if we believe that these are the source of the value additions of our investment. Our exit horizon is anywhere between, I would say, 3 to 5 years. We always invest with the base of taking the company public, and I'll tell you a bit later why. And we typically deploy anything between $20 million to $50 million in any company of straight equity. We don't use debt, not because of any Sharia consideration, because of the Middle East or so on. No, because we believe that in a growth model, taking sometimes unnecessary leverage risk is not the preferred option for us, and we'll talk about that. And it does have implication on our pricing discipline, on how you get in. Your cost of capital is extremely high, and so on. So we also take no less than 25 to 30% of any company. Our sweet spot has been about 35 to 40% of any company, so with active board participation and all the typical derived board committees, nomination committees, compensation committees, and so on. So yes, we have minority. Yes, we buy into companies. Yes, we do not take control, but we're very active on many other layers of the business. So that's a bit of, I would say, our model. I don't know if you have any question at this stage, so please feel free to interrupt and jump in. Any question? No? Please.
Why not leverage at all?
Why not?
20% leverage, 15. If you're buying with 15, it doesn't sound like you're taking.
Well, there are two reasons. Number one, you have to understand the market, the lender. Who is the lender in this region? You know, before the Deutsche Bank and the Credit Suisse of the world, when they came into Dubai, you had the typical, usual suspects of the banking scene, which were the corporate commercial lenders. So any type of, I would say, borrowing that you would have to undertake had to go through these 10, 11 banks in Saudi, for example, or the other Egyptian bank or other UAE banks. And these banks are typically conservative. So they do not lend on cash flow. They lend on name-based lending or collateral-based lending. So if you own assets, if the family, yeah, they'll lend to you, you'll borrow money. But if not, then they will not. So it's not, I would say, a lending based on the capital structure, on the cash flow of the business. It's much more on who's the lender. It's this large family that has tons of asset and tons of wealth that I can eventually, which can represent a huge collateral or a security in case of default. That's one. And number two, it's the asset. What do they own and who are they and so on. So it's not the typical cash flow lending, number one. Number two, we're a minority player. When you have minority, you don't have control. You can't consolidate the SPV, the acquiring SPV. And so the only, I would say, cash flow you may have would be a dividend cash flow that you may have from the OpCo, from the operating company that you bought in. And eventually, that's the only one that can subsidize, I would say, in a leverage at the SPV level, because you're not consolidating, you're buying into. So that's one of the reasons. Yeah. Is that clear? Okay. Please.
How do you deal with that? Maybe this is what you're going to get to. When you buy into a company with 35, 40% of it, you're obviously still can be outvoted and whatnot. So how do you deal with situations where you think something's definitely the right way to go, but you're outvoted at the table by people who might not be as financially savvy or business oriented as you are?
Wow, that's a great question, and I think that's the whole point probably of the case. So I'm just going to give you some ideas, and we'll go through it. Number one, there's a huge check that you need to do before. Who am I dealing with? Because the risk is a human risk more than an operating risk. You know, this part of the world is growing, and growing, fundamentally growing. It's not just an oil boom. There's a demographic growth, there's reform. So you have all the ingredient of growth. So the risk that you're taking is, I mean, these companies are growing, I would say, despite themselves. So if the manager has to resist for that growth, for that not to happen. So it becomes much more relevant to make sure that who's that person I'm dealing with? Is he open to change, and so on? And that happens a lot in the negotiating process at the beginning. You understand a bit what type of people, what is he resisting to? Are they decisions related to operating matter? Are they strategic matters, and so on? And you can understand a bit where's the point of tension going to be in the future. So according to that, probably you have a substantial set of legal matters that you need to work with. And even if you are one board member, and even one board member out of like 11, he cannot pass a resolution that relates to certain, I would say, matters that are of importance to our investment. So whether it's related to the budget, if he's trying to lowball the budget in the future, or if he's changing a bit the capital structure, having a lot of debt based on his name, for example, into the company or so on. So you want to have a say in the critical stuff that makes or break the investment, basically. So there is obviously a legal framework that you have to work with. It's not the typical legal American law or British law type of environment, but you have a set of reserved matter that you can enforce, even if you had one vote in the board, whether it's a shareholder matter or board matter. So that's how typically you protect. And we'll go specifically to what are these typical rights that you would require.
You'd mentioned you have more active LPs comprised of sophisticated investors and families. Can you talk a little bit about LP management? I'm guessing that it's a little bit different from a traditional blind pool of committed capital, and potentially how do you manage those LP relationships and how that might differ from a fund in the US?
Yeah, I mean, it's very relevant because for us as Amwal, we do not call them actually LP. We call them partners. They're not sleeping investors, they're partners. And in that context, they are more and less demanding. They're more demanding in certain stuff and much less in others. Let me tell you on where they're very demanding. They're demanding because they consider themselves partners. They've put 25 to 30 million bucks. So even for Warren Buffett, that's a considerable amount of money. And in that context, they expect you to tell them about the businesses, about how they're going, what you're buying, and so on. But in the same time, you want their input. You know, this is a region where you can't go on Google and just put in, you know, Saudi Arabia, market size, consumer goods, beverages. It's not going to work. What's going to give you a feel of the market is much more the players of the market. You know, if you have LPs in the distribution business or in similar type of businesses, they're going to give you much more business intelligence, data, and they have their own intuition. So they are typically leading merchant names. That's a great song, by the way. No problem. So, can't get the song out of my head now. I'm just kidding. So you leverage a lot this LP pool. So you get a lot from them in terms of intelligence. Now, the second thing you get from them, because they do not perceive themselves as being just sleeping investor, they are a great sourcing platform for you. So whenever great opportunities come to their desk, and actually they do come to their desk in this part of the world before coming to an investment bank, and these are the juicy deals that you'd like to have, they call you. They call you because they have 10% of your fund, 15% of your fund, so they can't put the whole ticket, and they say, you know what, you probably would do it better than I would do it. So there's a sourcing platform aspect that you can leverage. Now, from a reporting perspective, some of them are very sophisticated because they've been used to the quarterly and annual reports of the Carlyles of the world and so on. And some of them are much less it's more of a trust thing. It's like, we trust you're managing our money. At the end of the year, just tell me how's my portfolio doing, what is your fund doing, and so on. So the reporting is not as institutionalized. Now, if you, as a firm, believe that you should be at par with all these international firms, and that's, for example, when Goldman came in, we had to change the whole thing. For us, it was no longer a group of like friends and family that have gathered their money in Amwal, but you have an institutional investor that has tons of requirement. Well, they have like legal FCPA and OFAC requirement, but also they have to mark to market in their book because it's a balance sheet thing for Goldman Sachs and so on. So you need to abide by a certain set of processes and reporting standards and IFRS and so on and so forth. So when you do that, you're probably going to provide it to everyone as well. And you institutionalize yourself as you go along. So, sorry, go ahead.
So there, no doubt there's a lot of growth in that part of the world, but there also is a fair amount of political risk. And I'm wondering, how do you think about that risk, and then how do you quantify it in discount rates?
That's a very good question for Professor Gultekin. Let me tell you my view of the thing. Yes, you have a huge political risk in certain regions. I would say Iraq, for example, is a region where we decided and voluntarily decided, although it's proving very lucrative for certain funds and certain individuals, we've shied away from Iraq. We thought that it was still too unstable waters to venture into. But Saudi Arabia, I would say Egypt have, I would say, proven stability. Now you always have question mark of succession with Mubarak, or the Saudi thing seemed to be more set. So we typically, I mean, we live with that risk. That's why my base case IRR typically is not a 15% IRR or 17 or 20. I'm looking more in the 25% IRR in my base case, and I have to be very safe and comfortable about it. So my discount rates, I live with them. They are factored in the cost of debt to an extent, but I'm definitely not going to compound that, because this LP pool has given money to this fund to invest with complete awareness on where they're investing and how much they're going to get for it. So we don't take a view on political risk when it comes to the existing markets where we consciously decided to invest and assess that risk to be, I would say, more than livable. I mean, negligible, at least within a 5-year perspective. This is what we believe. Now, you always have risk of wars and an Iran war and so on and so forth, but you have the same thing, for example, in India and Pakistan, and this is something you have to live with in these markets. Sorry.
A question on back to your partners. How does that affect the independence of your investment decision? Especially when you use them for sourcing. It's kind of like they're doing a favor introducing you to a friend, and then you say, this looks great, but I won't pay anywhere near what he wants, or I just don't like the business.
Well, they're not part of my investment committee. Let me just tell you something. It's capital that I abuse and use, but I don't give them more privileges than they should deserve, because that would completely, I would say, undermine my rationale for an investment, and might bias me in a way or the other, because the business might be competing with one of his businesses, actually. And you know what? And you don't want to be in that position. So, we basically throw a name for name clearance in the network that we have, and we say, what do you think about this owner? Have any of your CEOs, they have tons of CEOs in their own companies, dealt with him? What do you know about him? What do you know about the industry? Those that provide you with input, typically very valuable, is more than welcome. Now, you keep this independence because you don't give them open book. You report what you need to report as a fund. Now, for example, we're in the process of raising a third $500 million fund. And we're going to see all institutional LPs from all around the world, from the CalPERS to the Singaporeans and so on and so forth. And these guys ask most of the time this type of questions. And we say, well, we leverage that network, but what do we give them in return? They're actually happy to provide that because they're going to make money out of it. And that's the Middle East. Sorry.
Just to follow up on the LP question, how are the terms for your fund? Are they similar or different to funds in the US, like 220 hurdle rate? And how is that change between your first and second fund? Okay,
let me just link that a bit to what private equity is, about how it evolved in the region. We have, just to answer directly your question, it's a 220, 8% hurdle rate, typical fund. So if you look at our term sheets or our PPM, it would be similar to any PPM modeled after like any of the usual suspect PPMs. So the terms are clawback, catch up, everything, carry compensation. So it's modeled completely after the Western, I would say, GP, LP type of model. Now, going back to that, you have to understand when private equity was born in the Middle East and when did it happen. And this happened not now and not 5 years ago, but I mean for the past 25 years. These companies, these families had a lot of oil wealth in the 70s that was poured into a lot of regional and conglomerates in the region that started buying a lot of private companies. And that's private equity, right? So our biggest competitors are not Carlyle. Now Carlyle came in, for example, but are much more these families that have a lower cost of capital, an exit horizon that's not bound by 5 or 6 or 7 years. So they can wait as much as they need to wait to make their money if they take a financial view. And if they take a strategic view, then you can't compete with these guys. So the LP-GP structure of private equity was something that was born, I would say, 7, 8 years ago, whereby you just completely modeled an LP pool of capital and a management capability, which is the GP, that basically manages the money. And that was something that started, I would say, in 2003, 2004. Abraj came in, we came in, and other firms came in, and you had now the completely independent GP LP, I would say, model that's following suit, I would say, in terms of all the practices. So we market our portfolio, we do FAS 157, we do everything that needs to be done to be as attractive as it gets to get an investor from New York or London or Hong Kong or Singapore to put money with us. Because I can't be halfway. I have to do it kosher. I have to do it the right way.
Can you talk a bit about the current competitive landscape of the private equity industry in the region? And when, in 2006 and 2007 with the boom, a lot of players mushroomed, and then some of which don't exist anymore today, some of which are on life support. A lot of investments with current portfolio companies are having trouble. How is the industry right now, and where do you see it going on the short and medium term?
Okay. Well, you have the I would say the local indigenous firm that were born in the region, and they were started by families or by smart investment professionals, and I'd like to think that we're one of those companies. So these are the regional companies based there that just basically started leveraging their own network to get the right deals. And the right deals being the deals non-marketed by the investment bank, but the deals that you're able to get by hearsay in a more social event, informal setting type of thing, as opposed to the proper deal teaser that comes through an investment bank where everybody's going to put money into. So these type of companies exist, and you have, I would say, 5. You had at a point 20. Unfortunately, because of I would say, in private equity, when an LP gives you money, you have to live. It's a commitment for the next 7 years. So if the company is performing poorly, the GP is going to still be there for the next 7 years, and only after the end of the fund cycle, that truth is going to unravel, and you're going to see that it's a GP that wasn't worth paying, and they've done a very poor performance, and then they would disappear. So you have a lot of these firms that were born in 05, 06, and 07, when you had a lot of oil money, and oil was at 140, that were flush with capital, and everybody and his mother raised a private equity fund. It was very easy. It was very fashionable. But did they stick to a pricing discipline? Did they buy the right asset? And when the financial meltdown came in, we were actually hit more than any other region in the world. Our capital market didn't go down by 30%, went down by 50 and 60 and 70% in certain part of the Middle East. So yes, we were decoupled from a Main Street perspective. So the economy was a bit decoupled. The growth was still there, the local economies, but the Wall Streets of the local markets were completely coupled, and even more violently so than you would expect. So these companies, I expect them to vanish now. Will it be now or tomorrow? I'm sure they're not going to have a second vintage fund. They're just going to have one vintage fund, their first fund, and that was it, because no smart LP would give them money again. You have the international firm that came in a bit too late. For example, Carlyle, Investcorp came in. You had some hedge fund that played with private equity in the region at a point. So these guys came in and set also their Middle East fund. And they came a bit late, and we're not sure that they came with the right value proposition all the time, but they're correcting that. And they're smart firms, and eventually they will evolve the right way. They probably parachuted some professionals from their New York office in DC, but guess what? You can't look at the deal in the region the way you look at a deal in New York. I mean, the corporate governance is different. The capital markets are different. The seller is different. You need to speak the same language. You need to be able to understand his concern. He will never accept for you dragging him along. Drag along clause in a legal agreement is something you'll never get from a Saudi, for example. You're asking me to sell my grandfather's business to this American firm or this French firm or this other competitor of mine. I'm never going to accept that. So you can't come with this preset of rules that you always adopted elsewhere and then copycat them to the region and say, okay, this is how we do business at Carlyle and so on. But these firms will learn, and they will adjust eventually their value proposition. And I'm sure that they closed, for example, Carlyle just announced a deal in Saudi. It's been their first in the past 2.5 years, and it's a great deal. So you have these international firms that came in with a value proposition, and they're amending it as we go along. So now Carlyle buys minorities. Carlyle is a buyout fund, right? Buyout firm, but they're doing minority in the region because the region dictates minority. If you want to do private equity, you need to be flexible. You need to understand what works. And you have the commercial banks. You have the commercial National Bank of Kuwait or other banks that have set private equity firms. some value proposition hold, but we also take a view that private equity has to be very, I would say, it can't be a hybrid product, can't be within a capital, it can't be within an investment bank. Goldman Sachs does have a private equity, but it's owned by, or Morgan Stanley has a private equity as well firm, but you have to respect the GP, LP, the incentive, the team, the carry, and so on. So some of the firms are doing a good job, but I think, so these are the three, I would say, type of players. And obviously the families, which are not private equity firm, but these are the fiercest competitor for us at least. And you have the sovereign wealth fund, which typically deploy their funds, but I would say elsewhere than in the region. Now they're being more inward looking. They got hit so bad, I would say, in the financial meltdown that they're now being a bit more, taking a positive view on their growing region, saying, hold on, the growth in our backyard and we're looking elsewhere. It was for diversification. It was for all money that had to be diversified into other assets. But now they're just taking a different approach of saying, you know what? Why don't we just seed as well private equity fund in our backyard? And so that's also evolving. Did that address your question? Sorry. Go ahead.
So you talked about the ability to go public as being an important criteria.
Sorry.
I'm losing
No,
my
don't
voice. You talked about the ability to go public as being an important criteria for your investments. Can you talk a little bit about the IPO market in terms of both demand for new issues, but also, differences between being public, private? Do the companies you deal with like the idea of going public, and what's the dynamic like over time?
Sure. Okay, most of the deals in this region are not take private transactions. They actually take public transaction eventually. That's how you. It's not a P2P from a public to private. What happens in the West when you see private equity firms taking over, a Blackstone taking over a public company and doing a buyout and delisting it, and eventually, a few years down the line, relisting that asset in the public market. So, as I said, it's a private economy. It's families, and these families are facing today a succession challenge, a growth challenge, and they're rationalizing their portfolio. So, you can't slice the business that's doing very well in 20 pieces because you have 20 nephews and you need to give them 20 different divisions. But what you can do is take that business public and give them shares. So it makes sense to take. So you're aligned a bit. If you were taking a view of, I want to take that company public, it will address the concern of the seller and your concerns as an exit. It's an exit venue. Number two, so you're not a threat as well to these families. You're just there. I would not say it's a marriage for life. It's like you're dating for 5 years and then you're going to be better off, both of you. So, and you're not here to change the dynamic of the relationship. You're just here to provide what doesn't kill you, make you stronger type of thing, So you're here to improve and complement the existing management families and eventually up their corporate governance to those of a public company. So when I say we take a view of exiting through public market is because we believe that if you put the company in shape and at par with public companies, you probably have a more valuable asset for trade sale, and you probably can take it public. So at least you can control one exit route, which is the public one, the listing process. And we've done that. But if you look at our exit, actually 1 out of the 6 exits that we've done has been public. But most of our assets have been listable. Now, the public market are very violent in this region, and we'll talk about it a bit in the case of the juice company that we described in the case. They're violent in one way. The listing process is very rigid and is very, I would say, streamlined and is very transparent and clear. So the rules, for example, for listing companies in Saudi Arabia, I would say even more, or Egypt, are extremely are perfect copycat of the British, I would say, FSA listing rules. So you know exactly what you have to do. You know exactly how you can take a company public, how much you should sell, the minimum, what are the legal requirements, so on and so forth. So if there's a set of rules, you just understand how to navigate. Now, pricing becomes another issue. You need to take a view as well on the pricing. Where are the public markets? We've lived, just to give you a few data points. In Saudi Arabia, when I just moved there in 2005, the public market were at 7,000 points. 6 months down the line, they're at 21,000 points. So had you put like $100, you'd have $300. And then 3 months after, guess what? They go down to 6,000 points. How can you take a view on going public? Well, you need to be very cautious. You need to take a long-term view. You know, the S&P long-term average, 100-year average, 75-year average is about 14 to 15 times earnings in terms of multiples. So we take a conservative view. We say, you know what? We believe that our exit is going to be, no matter where the market is today, on the long run, we're going to take the conservative view. We're going to do it as low as it gets, like 13 times earning, for example. So guess what? My entry has to be much, much lower. So we take a view as well on these volatile capital market are not, I would say, sustainable on the long run, and they will adjust to normality as the market matures. Did that address your question? Go ahead.
So many of the emerging markets, they're large enough so that, like Brazil, India, China, they have often funds that are denominated in the local currency, which makes sense for the GP, which has to deliver a certain return based on its own currency. And if you have your national LPs, they're probably diversified. For your specific case of an emerging market fund that invests in several countries, so you're exposed to several different currencies, and I think you inferred that your fund is dollar denominated.
Dollar, yeah.
Which is bad for you as a GP, because then you have to deliver in dollars when you're investing in whatever currencies. So how do you
That's a good
balance
question.
and manage
Well,
all those risks?
Well, let me just tell you, most of the investment we've made are in region where the currency is pegged to the dollar with a stable fixed rate. So unless you have you'd have to have huge political changes for that, like Saudi Arabia. Yeah, but more, like that's the wrong example, Argentina for me. But Saudi Arabia is pegged to the dollar, the UAE is pegged to the dollar, Qatar is pegged to the dollar, Bahrain is pegged to the dollar. These are like amongst the largest economy we invest in. Egypt is not, but you have hedging instrument on Egyptian pounds. Certain investment, we do take a view on hedging. We have not yet because we've taken a view on currency so far and played in our role. But I mean, if it comes to a significant currency risk, we probably would hedge against. And there are today instruments. I would say exotic instruments that you can use to hedge Egyptian pounds, I would say. But even Lebanon is pegged to the dollar now as well. So it's much more like some people. You have to take also a long-term view. One of the LP told me once, it's like I'm buying a local currency with an open option, because if anything, the devaluation is going to play in favor of Saudi Arabia or anything like that. When the only time when they thought about depegging was because it was not sustainable for them, and the Saudi Riyal, which is the local currency, was underappreciated vis-a-vis the dollar. So it's probably a blended free option that you have against the devaluation in most of the economy, mostly Saudi, the UAE, and Qatar. Yeah.
Some funds look at this volatility of the stock market as an opportunity to acquire public enterprise when they're in the lows, and sell back when they're in the highs. So do you think this approach to buy both private and public companies depending on the opportunities?
You mean to buy companies when they're public at the low and the end of the market? I mean, good luck timing this market, because it's a very difficult market to time. And I think a lot of people burn their fingers playing with this fire, and it happened. So now you have some funds that were not specifically private. Our mandate precludes us from investing in public companies. I mean, that's we're doing private equity. Our LPs can probably access the public market without us. So they don't need us for doing that if they're going with us.
Just acquire a large share and 30% of the company as you do being a public trading company.
Well, we did that actually once in a public company in Lebanon, and we bought a 5% stake of a bank. We're the third largest shareholder. I mean, the largest shareholder had 12% or 13% of the bank. So, but we didn't buy it in the market, because if you buy these markets, for example, in Lebanon, it's a very thin liquidity market. So if you were to buy 5%, you have to get that in 18 months of share accumulation, and you know what that would do to the price, right? So you have to buy it off the market in a block trade. It's kind of a negotiated sale, pipe type of transaction, and that's how we sold it as well. Now, buying in certain countries 20% or 30% stake is feasible. We did pursue a couple of opportunities at a point in the Saudi market, but I would say the regulator is fearless, is very rigid when it comes to protecting the interest of the retail investor. The capital markets in Saudi Arabia are, I would say 80-85% retail driven. So it's not like the Fidelity that's making market maker type of situation. It's much more the common people in Saudi Arabia that own stock in the public markets. And this is the bulk of the market. So the regulator takes a view that I need to protect these people from the institutional companies that are coming to manipulate pricing and so on and so forth. So the disclosures taking private type of stuff are very, very difficult. To come and control and change the board and pay yourself a dividend and get out and structure something with some debt, this is something that you cannot do easily. It will evolve once you have a market where 60% of the float is institutional, and that will come. We're seeing some improvement, and we're talking about now probably 80% still retail, but still very significant. So difficult strategy to pursue. It can be very lucrative, and some people consider it. Sorry.
How has been your experience with enforcement of contracts over the last several years? I mean, through the downturn, have you seen difficulties where there were some warranties given where you couldn't enforce them, given that you're a minority stakeholder in most of the companies? How is the court system?
That's a great question, and we're very lucky so far that we have not come across a legal problem of enforcing minority protection rights, and we hope not to. I mean, anywhere in the world, if you go back to your shareholder agreement, you're in trouble. That means you're going to have litigation is trouble. It's not good for your investment. In the Middle East, probably even more trouble. So you'd rather not go there. Now, we do everything by the book. Certain jurisdictions have, I would say, do not have a precedent type of based law. So you can't rule just because something happened in the past. And sometimes the precedent doesn't even exist, the precedent. So in certain investment, we structure our investment in BVI or Cayman Island vehicle that own when you don't have foreign restriction ownership. And there you can protect yourself because you have all type of minority protection enforcement matters. Now, when you do directly a deal in Saudi Arabia, for example, when foreign ownership is not allowed, so you can't structure it through a BVI or a foreign or an offshore-based vehicle, it becomes a bit more tricky. And this is where it's not a legal anymore protection you're looking for, it's who am I dealing with. And this is where your LP network, coming back to the LP network, becomes very important. Like, let's say I've agreed with someone that any debt injection would require my positive vote, no matter what. And he decides to overrule it. It's going to create trouble. I have a shareholder agreement, but go and enforce your shareholder agreements. What I can do is I can go back to my 10 LPs and talk about this guy. They sit on 5 of the top 10 banks in Saudi Arabia and start ruining his reputation. And that matters much more in this part of the world than just the legal agreement. So the deterrent, the stick, works sometimes better than the carrot in this part of the world. And that's why you need to have people that have intelligence, have access, that are influenceable. People care about their reputation. And I think the reputational deterrent is equally important to the legal one in this part of the world. Any more questions on this section? Okay, so I think we spoke about everything. I'm done. No, I'm just kidding. So, yeah, let me just tell you a bit about the difference between the regions. You hear about the Middle East, you think it's Dubai, or you hear about the Middle East, you think it's Egypt, or so on. Let me just give you a bit of a macro view on the region, and because some of you might be interested in living in Dubai or Abu Dhabi, but not interested in Saudi Arabia, which I understand. It's much more difficult. But I mean, let me just give you a bit of where the money is and what happened. So, I would segment the Middle East into 3 regions: the Levant, which is more small countries like Jordan and Lebanon; the GCC countries, which are the Gulfian countries, Saudi, Oman, Abu Dhabi, the UAE, Qatar, Bahrain, and Kuwait. And then you have the North African countries, Egypt, Morocco, Tunisia, Algeria. So this is what we look at the Middle East. So just to give you an order of magnitude, the population in Egypt is 80 million. Population in Saudi is 25. In Morocco, about 20, I think. Lebanon is 5 million. Dubai, as an emirate of the UAE, is 1 million people. Out of them, 200,000 local Emirati, and the other are expats. Likewise for Abu Dhabi, about 1 million plus. So it's a 5 million population. So you hear about the UAE, but it's a 5 million population, and you have an 80 million population like Egypt. So depends what industry you're playing. You have to look at size. Size does matter in this part of the world, everywhere actually. So Saudi Arabia is one of the most lucrative for us and the most important market because of the growth fundamentals. You have a lot of reforms happening. It's a traditional society, pretty conservative. I would not lie to you on that. But at the same time, It's going through a lot of positive reforms. Things happen slowly, but they do happen. And unfortunately, Saudi is a very poor marketer of its progress to the world. Even the guy at the customs is not friendly. You go to the UAE, he's smiling, he's used to foreigners. So it's a matter of marketing and PR. It's a country that doesn't know how to market itself, but it's a country that's moving in the right direction. GDP is about $400 billion. About 45%, 50% of oil, depending on all GDP base, depending on where the oil price is. But the important factor is that the non-GDP, non-oil sector is growing faster than the oil sector, which is always subject to the fluctuation of the pricing and also on the output. So it's a growing economy. 70% of the population, 25 million people, is below 30 years of age and growing at 3%. So even outgrowing India in terms of the percentage of growth of the population. So if you're playing certain industries and not the typical oil and gas thing that you would think that this is what the Middle East is about, like healthcare, education, retail, consumer retail, consumer finance, so on and so forth, you're doing the right thing. You should not be affected by oil prices. It's domestic growth fueled by huge output growth, which is the population. And reform happened, WTO, foreign ownership, and so on and so forth. So we do like Saudi Arabia. We think it's a great private equity market. People didn't want to do business there, wanted to do business there, but didn't want to be based there. But guess what? It doesn't work. You need to be, unfortunately, in Saudi Arabia if you want to do deals in Saudi Arabia. And that's why very few private equity firms decided to headquarter their office there. And until very recently, just a couple of them had to abide by the new realities of the market after the crisis. When Dubai tanked, they had to think about the real economies. And they went and looked at Egypt more and looked at Saudi more and so on. So that's a bit about Saudi. So 25 million people, growing, a lot of family businesses, a lot of money in the country, and a lot of growth coming in. And reforms. Capital Market Authority in Saudi is probably the most advanced, more advanced than that of the UAE, although not a lot of people. We're talking about a capital market that does about $2.5 billion of daily trading. It's pretty large, about 140 companies going public. Just to give you also an order of magnitude, in 2008, you had one public company in months. So you had one listing a month almost in Saudi Arabia, even 1.5. Up till from 1992 to 2002, you had only 2 public listings in a decade. So that gives you how a sense of the evolution of the market. And so this for private equity means good industries, good growth, exits, and expansion of earnings because of growth. So that's what we look at. UAE, still, 150 to 200 billion dollar GDP, 5 million population, 80% expat, 85% expat, 15 to 20% of local population. That also has an implication. When I tell you 25 million Saudi, it's like 90% local Saudis. So the growth is very Saudi-centric. In the UAE, the growth has been also expat-driven. You have a lot of expat. And in crisis time, expat take a view of going back home. And this is what happened a bit in Dubai recently. So you had a bit of population shrinking. And population shrinking probably is the worst effect for any private equity firm that you can look from. This is the output. This is the input, basically. This is what you're feeding the machine. So corporate earnings and so on and so forth. It's not like they're spending less. It's like they're no longer there. So I'm not making the situation more dramatic, but you have to take into account the expat risk and the touristic and the population, the demographic drivers of the UAE, for example. Yet, it is a market for us that's very interesting for services, for tourism, for certain industries where oil and gas services, for example, is hefty and very interesting for us, and we've invested a lot in that in the UAE, in Abu Dhabi and Dubai. Egypt is another, I would say it's the 500-pound gorilla. It's an 80 million population. GDP is lower, low per capita GDP, about probably 150 or something like that, a bit lower.
1,200.
Sorry?
1,200.
1,200 per capita. Okay. No, I was talking total population. Okay, so growing economy, good reform, good capital markets, very deep, and good foreign ownership. One of the biggest drivers for the Egyptian economy was the FDI. Was a lot of inflows of foreign capital into Egypt, fueling the economy, helping the economy in Egypt. So very positive, I would say, dynamics for private equity. Growing population, and a lot of, I would say, interesting industries that we played in. Energy is a very promising promising segment is a promising sector. The second one would be demographic driven, like consumer finance, healthcare, education in Egypt is very interesting, and labor intensive. You're talking about a skilled labor that's pretty cheap in Egypt, and it's becoming the manufacturing hub. It's actually a little bit overtake Turkey in extent to being the manufacturing hub of Europe. And you know, with the custom duty, you don't have to go through the Suez Canal and so on. So you have also a transportation advantage. It's pretty close to Europe, it's pretty cheap, and they're skilled. So these are, for example, like textile in Egypt and other industries have been very interesting for us to invest in. So the other, I would say, we look at the other countries opportunistically. Like we did invest in financial services in Lebanon and made pretty good money and good returns in these countries, but it was opportunistic. North Africa and other countries, we haven't gone there. Not that we don't think they're good, it's just because we don't believe that we have the network for that. And we're not going to venture into a country just because we think we should do private equity there and it's in our mandate. So we haven't done anything in Morocco and Tunisia. Algeria is more difficult. It's very hard to get the capital out. So from an exit perspective, you need to manage. You need to have very creative, I would say, structures to get your capital out of the country, and that's probably a nightmare for any private equity firm. So a lot of people shied away from Algeria so far. So
just quick question, just relating back to Saudi Arabia. A typical investment thesis for emerging markets is growth of middle class and growing importance in consumer markets. Egypt, from the sectors you're explaining, sounded a lot like that. How is that in Saudi Arabia? Is it still extremely concentrated in oil wealth, and like what's the size of the middle class and how has
it's a typical LP question, like in my fundraising roadshow. That's a great question.
No money.
Huh?
$200,000 in debt.
Okay. Okay. Well, listen, I mean, it's very difficult to explain to LPs, to tell them that, you know, what you imagine in Saudi Arabia being like, you know, that's true that the top, I would say, 1% of the population does control probably more than, I don't know, 80% of the wealth. And probably that equation is changing with time. But you have to take into account that the behavior in Saudi Arabia changed for two reasons. Number one, let me just give you a bit of a historical background before that. In the 70s, the oil boom, the first oil boom in Saudi Arabia, most of the money was spent on huge infrastructure. Like they built the capex of the country, basically, the infrastructure of the country. So heavy capex investment, huge roads, huge highways. It's a big desert at the end of the day. It had a lot of oil, but it's a big desert. So you need to populate it. Huge airports. Some of them were obsolete, had very few travelers every day, but they carry the name of King X and Prince Y, and it's glorifying and it's beautiful. But that happened. And also that money went into, I would say, the extravaganza of some Saudi princes spending a lot of money, being on the payroll of the government, and with private jets and so on. And that was the 70s boom. The money was not spent on the population. Things changed. 2000, oil boom, the money was going to a population that was heavily unemployed. The Saudi debt to GDP ratio was more than 150% back in 2001. And you had a very poor unemployed class with an official unemployment. The official unemployment number were about 35%, but considering that half of the population is female and they don't work, that's probably a wrong figure, and it was even higher than that. Now, when King Abdullah came into power in 2005, and even earlier, he started running the country when his brother was sick. And this oil money was spent much more wisely. It's spent much more on, it's no longer on defense, on beautiful F-16, that they had more F-16 than pilots. Pretty interesting investment. So it's spent now on healthcare. You have one of the biggest hospital now being built in Saudi Arabia. On education, you have about 30% of the budget spent on education. They created the KAUST, which is King Abdullah University of Science and Technology. They started with a $10 billion endowment. They're creating, like Princess Noura University, a $12 billion project. It's going to be 3.5 times the University of Pennsylvania in 3 years. So they're going all out. It's either go big or go home type of thing. So that's what they're doing. So they're spending on the right things to educate to create a welfare, I would say a welfare state, the well-being of the population. And the reason is not like selfless. I think they realize that if you have a poor, unemployed population, you're going to have much more and more Bin Laden type of people and fundamentalism, and that's not going to help the regime in place sustain itself. So if you educate people, if you give them healthcare, housing, and so on, you're going to have a population that's a bit happier. They're going to be more rational, and this Qaeda type of influence that happened at a point in Saudi, and it was kind of I would say this risk has been majorly eliminated because of this wise, I would say, spending. And what helped them a lot was the money that they got. I mean, we're talking about $500 billion of capital, and with the central bank of Saudi Arabia, that's conservatively there. So if oil is to go down today from $85, I think, to $15 for the next 5 years, Saudi can still sustain the same GDP growth thanks to their saving by spending on the right things. They also used to spend a lot on exploration of oil. Now they're spending on services, on not only downstream, midstream, and upstream, not only just exploration of oil. So they're also trying to go to petrochemicals. We have oil, let's go into the products as well. You have SABIC, which bought GE Chemicals, GE Plastics actually, which is one of the largest companies in Saudi Arabia. They just bought one of the leading global companies in that. So the approach has changed, and the middle class is basically benefiting. And now you're seeing this middle class coming in, people going to universities and so on and so forth, healthcare. So there is a movement, and I think the trend is pretty well set. I think this king had a great vision, and we were talking at lunch with Professor Gultekin, and he came to power, he was 75. People say, 75 is too old, doesn't have the energy and the stamina to do much changes. And he said, well, I have 5 years to live, let me change as much as I can. So screwed everybody up. So go ahead.
You briefly mentioned about Turkey, and a few years ago there was a lot of capital flow from Middle Eastern investors to Turkey, but now it seems like it's slowed down significantly. Do you see this coming back anytime soon? How could the views of Turkey change in the
Listen, I have to be very honest that I don't know a lot about the Turkish market and private equity landscape, but I will just tell you a bit of what we think about it. Turkey has been looking a lot west and European Union at a point, and now I think you can see that Turkey is looking more east. So they're looking even politically and economically. Now, at a point also, you had the Ottoman Empire, and you had huge and strong ties between the Ottoman empires. Most of the region was part of the Ottoman Empire, and after I would say the Turkish Revolution, or Ataturk came into power, and it changed, the whole dynamic changed, and even Arabic was no longer the language in Turkey. So the Arab also took a view that there's a big dissociation. It's a different. You can't consider the Turks and I would say the Arabs, if I'm to judge by ethnicity or to regroup by ethnicity, have very different, I would say, aspirations. And that got closer, I would say, recently now, with Turkey looking more east politically. So, they get involved much more in the Israeli-Palestinian problem. They're taking a view on the Iranian conflict and so on. They have good relationship with most of the countries, whether with the Arabs, decent with Iran, with Israel, and so on. So they found themselves a certain niche, and I think they're being maybe more successful than the relationship that happened with the European Union. So, but what does that mean for us? Now, for us, we don't have much trade of people movement of labor you have a lot of movement of labor between the UAE and Saudi, between Lebanon and Saudi, Lebanon and the UAE. You don't have the same with Turkey. You have very little movement of capital between countries. But you still have an Arab appetite saying, I would like to invest in Turkey, but it's a different market. So you have, if you look at private equity, you have a lot of private equity firms. You have Carlyle, Blackstone, KKR having offices in Turkey. You have a lot of private equity firms being based in Turkey that were there. But these guys are very Turkish-centric. I'm not sure if I invest in a company in Saudi, I can take it to the UAE. Probably the dynamics are going to be slightly different, but I would say 80-20 rule type of very similar dynamics. Turkey is a different approach, completely different setting, different rules, different type of thinking, so on. So for us, for example, we never stapled Turkey into the Middle East. Some private equity firms did take a view that, yes, Turkey is part of the Middle East, but why is it? And we speak all Arabic, for example, in the Middle East. Turkey is a different language. So we believe that there is a synergy of, speaking the same language. There's the GCC, which is an economic zone, aspiring to be like what the European Union is today, so on and so forth. So I would say probably moving politically and maybe economically. Hopefully, you'll see more. Now you have also a Saudi firm, Saudi OJ, that bought a big stake in Turkish Telecom. So you started seeing that, but it's not there yet. I think maybe too early. But probably a relationship that started now even more.
Develop a little bit more the synergy you can create in the Middle East, and specifically between Middle East and North Africa, besides media, which I think it's very difficult to make successful investments.
You mean between?
What kind of synergies? For instance, give us a theme or an example of a company that you think is Saudi or Egyptian, and you can replicate the model or expand it very well in North Africa, Morocco, Algeria, Tunisia.
You know, the Morocco, for example, is very much French. Morocco, Algeria are French influence. So you see. I think they had historical ties with French. There's a history of the colonial French power before as well, and so on. So, we have not yet developed, I would say, the same relationship between all these countries and the other country. Politically, yes, they have a very good, I would say, understanding and so on. But economically, we haven't seen a lot of movement. You have seen a lot of capital going to Algeria, for example, at a point. You have seen real estate companies like Emaar going to Morocco and developing a lot of resorts. Solidaire, which is like an Auger, Lebanese/Saudi company that went as well to Morocco, was Solidaire International, looking at certain projects. So we saw a lot of real estate. They perceive a lot of touristic potential, for example, for Morocco. A lot of petrochemical and oil and gas potential for Algeria. I would say Tunisia would be very similar to Morocco. Honestly, I'm not the expert, so I will not venture into what I don't know. But I know that media, as you said, so excluding media, I know a lot of companies and a lot of creative directors and the Omnicoms and the TBWA and the others that have great offices in Morocco and serve all the region. But we're yet to see the, I would say, the flow and the exchange of capital and labor between these countries.
You have about 21 minutes, and you have a very interesting case.
Yes, that's true. But I mean, I got dragged.
We can spend a whole week on one issue,
Okay.
so we have to.
Okay. I thought when we did that case, I remembered my time at Wharton. You should have spreadsheets in a classroom. So I thought that we need to go into some structuring and stuff like that. I'm just going to give you a bit of those that didn't read the case, and I'm sure some of them didn't.
No, that's not sure.
I'm just kidding. I'm just trying to find a way out. So let me just tell you a bit about Juiceco. This is a typical. It's so not natural to call it Juiceco because it's not the name of the company, and we lived with this company for a few months, but because the deal never closed, so we couldn't reveal the real name. Not that it matters for anyone here, but still, it's confidentiality. So this is a typical Saudi. Yeah. Forget about the numbers. This looks very boring. Let me just go where you can't see anything. Okay, it's better. So no, just because to introduce you a bit the company. So this is an entrepreneur, not the typical rich Saudi families. I would say a young, smart entrepreneur that started his career in the 90s working for a factory, a UAE factory of juice and water and beverages based in Saudi Arabia. Did a great job with the business, bought the UAE partners out, became the only, I would say, entrepreneur that started with a production line. The company with one production line, a single one, does this little cheap, I would say, juices that you sell for like 25, 30 cents to the schoolboys in Saudi. You can find at the gas station, you can find in the little like type of delis and so on. So this very cheap, simple product with a brand, not that big of a brand, but pretty known. Very interesting, targeting the mass market. So this is the bulk of the market in Saudi Arabia, 25-cent juice, sugar and water with a flavor. So he basically took that company from a tiny little business up till 2007, 2008 to a company that was doing about, if I recall, well, I have the numbers. Yeah, so about $7 million of net income, 7 production lines. And one of our colleagues, Tarek, who's a colleague of mine, joined from business school from McKinsey and joined Amwal about 3 years ago, met the gentleman in a very informal setting at his uncle's house. spoke about Amwal, and this guy was very conservative, I would say, in terms of like a very conservative Saudi, not used to debt for religious reason, but also for, I would say, debt is bad. I don't want anybody to owe me anything type of thinking. And Tariq said, you know, if you want to grow, why don't you speak to a financial investor? What is that? Develop the communication. So level of sophistication will be less than Finance 101, but operation, he probably could teach us all operation. This guy knew how to optimize and the manufacturing process to the dot. Great control on procurement, great control on costs. Done a great job. Was doing very, very well for himself. And he still was looking forward. And he said, I want to take it to the next level. So we met the guy from the deal. Asad was here as a colleague of mine who joined an Amwal in 2007. Formed the deal team, myself, Tariq, and Asad. And we went and saw the factory, and we were very impressed by the process. And not only by the guy, but also by his CEO. He has recruited a very competent CEO that came from a development fund owned by the government that typically lends to these type of companies, and a very Sharia-friendly type of structure. So we met the gentleman. We were very impressed, and we said we want to invest. He said, I need 100 million riyal, about $30 million, to add a couple of production lines. I want to do this product, a PET type of product that I think this is the future. And I'm sure if I push it through my distribution network, I'll do very well. We're not very happy with the distribution network, with the marketing capability of the company, but we knew and we realized that he was open to have a marketing manager to boost a bit the branding of the business, because he was a great manufacturer, but not that great of a marketer. And he could have done a much better job on pricing and so on and so forth. So we said, we're very interested. This, from an Amwal perspective, this was a company that was in Saudi Arabia, that wanted to grow in Saudi Arabia. We're talking about a cash-in. You know, cash-in, basically taking the money and putting it in the company to finance that growth. So we're not talking about an entrepreneur that wants to cash out, make a few bucks and sell you his shares and even 20, 30% and reduce his exposure. We're talking about somebody that's really saying, I want to put more money, plow more money into the business because I believe in it. So we like that behavior. This is exactly what we do, growth capital. He wanted to sell about 25 to 35%, so board representation, so on and so forth. So it fits also the ticket size that we're looking into from a share percentage perspective and from a dollar perspective. Exit-wise, this company was going to a scale. Typically in Saudi Arabia, you need $10 million, typical minimum net income, excluding corporate governance and stuff, to go public. So he ticked the box of a potential candidate for a public listing. So we saw potential exit. And basically, it was a great industry. This is a industry that's focused on Saudi Arabia, mass market, consumer good, growth. I told you about the demographic dynamics of the country. So it was very interesting. Now, give you a bit of context as well. This is when the markets in Saudi Arabia were doing like yo-yo type of, like going from 7,000, 21,000. At the time, the market was doing extremely well, buoyancy of the capital markets. So we were a bit nervous about that, but we were living in this environment and we needed to adjust to it. We spoke to the gentleman. We said, what is your pricing expectation? He was generating about $7, $8 million of net income, and he gave us his range, and it was from out of whack. For us, it was crazy. We're never going to pay these prices. Now, if I tell you, why do you think price is important? You're going to tell me, well, that's obvious. You're a buyer, and price is important. But for us, it's even more important. And the reason why it's more important is, number one, we're an all-equity player, so we derive no financial benefit from any leverage. So we're a pure equity player, so our cost of capital is very, very high, and you have to be very stingy. Number two, we have a managing partner that's very stingy in terms of buying companies only. So he said, Fadi, I'm not going to pay for that more than 8, 9 times earning. Now, 8, 9 times earning because we always want to make money out of multiple expansion. We're greedy. We're a private equity firm. And we say the entry is the first source of value. And many private equity firms forgot that for a long time. Why? Because they had a lot of debts in the backyard. And they say, you know what? Price doesn't matter if I'm able to put 95% of financing on it. I'm going to make money, especially at 8, 9% debt, or even at the 10 or 12% debt. In a growing region, we didn't have that luxury. So we had to be even more rigid on that. We took a view on the long-term exit of this company. We said, well, we probably could list it at 13 times earning. Eventually, that's where the public market are. Even though at the time, the comps were doing trading at 21 times trailing earnings. So we couldn't afford basically the company at the price that the seller was looking into. And we spoke to him many times, and we said, let's run the numbers. So Asad went and built a model. And we did a very plain back-of-the-envelope, not Wharton sophisticated type of model in the sense of buying at 9 times earning at the price that he was asking. He initially asked for what you see at 330 million. We knew from intelligence from the guy, the CEO, that probably he would settle for far less, 25% less of that number. So about 12 times earning. But that for us was a no-go anyway. So we plugged the number into a model, and we said, 5 years exit, 13 times earning. Let's take his projection at face value. And his projection did factor already the growth of the company in moving forward with the new production line. Talking about a company that makes in 2011 out of starting 275 million, 700 million. So almost like tripling his sales in about 3 years. Pretty big challenge. We understand that the PET product is great. It's sold pretty expensive, and he could push it and great net income margin for that product. So we run the numbers, and we realized that it didn't make sense for us at certain levels. So if you look at the sensitivities that we run out, we realize that, at 100%, we probably make a 20, 22% gross IRR. Deduct from that the fees and everything, so you give your LPs about 18, 17% return. But we realize that if he does 70% of his earning, of his projection, let's say a simple assumption, we get hit bad. And 70% of his projection means he's making 500 million top line, not 700. And 500 million is pretty hefty. It's doubling his sales in 3 years. So that was a risk that got us very nervous. It made sense if he was truthful. Didn't make sense at all if he does a bit of underperformance. So we're very nervous about the entry pricing that we were looking into. Sorry,
Aditya. Question on the entry pricing. So a lot of the growth that was coming through in the model was based on your investment. So why would you pay an entry price which is higher? Because you are anyways funding that growth, right? You're upfront paying for future growth, which is again based on your money. So isn't it like overpaying?
That's a great point, because that's where we're telling him you're valuing the business based on the money we're providing you. You can't do that. We can't take a view that you can't factor the cash in component that we're putting in that's yielding a certain return on equity and then project it. But go tell that to a 55-year-old guy that doesn't know Finance 101, and good luck. So you have to adjust, and you have to create something not to offend him. And that was very, very challenging for us. And I'll tell you what we did. So.
No, back to Aditya, I think a large proportion of entrepreneurs in the emerging market, they'll factor in the money that you will give them, their projection. And I think they provide a very valid reason. Basically, you're providing me with a capital that has a certain cost. And this is how I'm going to price the cost of capital. I'm going to price it to give you appropriate returns. Mm-hmm. But what you're buying in the real option plus the stake you're getting. So I think, I don't think it's something that is completely out of whack.
It's not out of whack, but if he didn't have his 100 million and he doesn't have any financing alternative, he can't reach his projections.
But he has, you're assuming that only Amal Khalij has it, but there are a number of financing sources competing.
No, I'm saying as a standalone, if he's not to partner with anyone, can he just get where he wants to get? He can't. And it's an established fact. Now he needs a partner, and that makes his argument debatable. That's such a big jump can only be made with an external injection of capital. And it's an established fact. He can't realize these projections. Now, definitely there's not only Amal Khalij, otherwise I would have bought this company for very cheap, and that didn't happen. Sorry, yes.
Yeah, just on a technical point, follow up to this conversation. You know more than me, but it's always this discussion of post-money, pre-money valuation. Mm-hmm. And do you use post-money projections and get a post-money valuation, or do you do pre-money as a status quo projection, and then you add to it what you invest? And based on my experience, it's always post-money projections. You get you post-money valuation, and then you deduct the amount of capital that you're injecting into the company, and that gets you to the pre-money valuation. And I'm not sure if, Professor, you agree that that's the best theoretical way to do it, but that's how it's done in emerging markets. So, I don't want to preempt you, but I'm sure you reached some sort of an earnout, basically proposal to see whether he
was
basically
written here.
achieves his values. I can't see that far. But a combination of pre-money, post-money, and an earnout structure would usually bridge that gap in valuation.
Okay, I think you should come here and present the case. He got it. Wasim got it right. I think. Sorry, go ahead very quickly so we can move ahead.
The other way to do it, if you don't have an earnout structure, is we've tried the preferred route. So you have a preferred structure where you invest at say 8% coupon, and then conversion is ratcheted based on the performance. That's actually a more simpler structure because it basically you pay for what you get through the ratchet. But I don't know whether preferred is allowed again in Saudi culture.
Well, that's the problem. You saw in the case. I don't know if options are not preferred or typical. I mean, Saudi is more difficult. In other jurisdictions, it's easier. So the preferred wasn't an option. And this is the environment that we have to navigate through, where we have to navigate through these type of challenges. You have very little enforceable right in certain things. You have no options. Preferred are difficult to structure and so on. Convertible, even more difficult. Actually, convert would have worked, for example, pretty well as well. You know, fixed valuation, then you convert on a certain valuation based on certain milestone. But it doesn't work. You can't force somebody to sell something at any point of time. So it doesn't work. So what got us nervous, just because before I let Asad a bit tell you what we did really, because I'm not as smart to do like spreadsheets and stuff. He knows how to do it better.
What happens to you once you get promoted?
Just trying to be modest here.
I'm just trying to be humble. So what got us nervous is this, is, you know, 70%, 80%, 90% of his projection, and we're off. So my downside protection was more important for my investor. Number one challenge. Number two, he had 3 years, so we have 3 years to see the full effect of this like improvement of the production process, the new production line, and the distribution network that he wanted to spend money on, and so on and so forth. So we were not comfortable with that. Number two, I have an investment committee that, you know, when you get somebody used to something, he takes it for granted. So if you always delivered like low multiples, all of a sudden you come with a high multiple, you say, are you crazy? Well, that's what happens as well. So we didn't want to have a clear no-go from investment committee if we come with something that was way off the expectation. And typically for us, it's a 9 times earning. And 9 times earning, 10 times earning has been our like max price paid, because as I said, we try to convince people that in the future they're going to be better off if they sell us cheaper today and not the majority, as opposed to selling the majority at a slightly higher price to somebody else. Because with us, we're going to do a better job together. I mean, that's the story we sell. And it works. So let me just tell you a bit of, introduce a bit Asad, who's basically worked on the structuring aspect of this transaction. And without being too geeky and technical, we're going to just try to tell you a bit what we did. Go ahead.
Thank you. So for those of you who don't have private equity experience, this is a typical situation that we face in any transaction, especially in the growth capital model. So on the one hand, you have the seller trying to get maximum value for his company. On the other hand, you have an equity firm trying to get the lowest cost basis for its investment. So the result is an large valuation gap. As some of you just mentioned that the best way to bridge this gap is through an earnout structure. What is an earnout structure? It basically buys the historical performance of a company and compensates the management for future performance. It's usually linked to certain business or performance milestones, and it extends for a certain period, predefined period of time. So in this case, in the case of Juiceco, the metric we used was net income, and the earnout extended for a period of 3 years. You probably want to ask me why net income, because the base case exit scenario for this transaction was an IPO, and public listing in this region happens based on PE multiples. So 3 years, we had 3 years horizon here, because we were expecting the company to capture the full potential of its new production lines after 3 years. And this is where most of the execution risk lie. So we had here, So we had here Dr. Ali asking for a valuation of 247, and even though this was well below 25% discount from the 330 million valuation, this was still a 12 times PE multiple. Well, this was not a level acceptable by Amwal Investments Committee, which, as Fadi just mentioned, was pretty much used to accepting transactions with 9 times multiple. So based on the 9 times and expected net income of 21 million in 2008, the valuation or the starting valuation we came up with was 188 million. This was a huge gap. So basically, through this earnout, we tried to bridge the gap. This earnout has 3 elements, or 3 buckets. First of all, valuation today, which was the 188, the valuation adjustment that was to happen throughout the 3-year period, and the compensation or the rewarding Dr. Ali for his performance. So based on the 100 million that the company was in need for, our stake, based on the post-money valuation, was 34.7%.
Is that clear on how post-money, pre-money?
Experts. So we started off with a 34.7% stake in the company. That was the day 1. And this percentage or the valuation is to be adjusted based on achieving certain milestones. As Fadi just mentioned, based on if the company delivers 70% of its projections, the IRR for Amwal would be 14%, which is not a lucrative IRR, and definitely this is something unacceptable for a private equity firm. So the level at which we were comfortable, or the returns where we were comfortable for Amwal, was 90% of projections. That would yield an IRR of 19 or 20%. So this is why we came to Dr. Ali and said, look, if you promise if you deliver what you promise in terms of projections, we will get you from 188 to 247, or very close to that number in 3 years. You know what? Even better. If you don't have to reach 100%, even if you reach 90%, we'd be very happy. But even better, if you beat the 90% and up to 110%, we'll be both happy. So any net income level above the 90%, you will get the valuation adjustment. So in this case,
sorry, if I may, so we were willing to reward him on slightly missing his projection by 10%, but also we were willing to give him a performance incentive for even beating his projection, but not indefinitely. So we created a ceiling and a floor. The floor was 90, the ceiling was 110. And we said anything here you're gonna be adjusted.
so this was the range for the earnout, or where the earnout would be triggered. So based on this case, we've assumed that the company would deliver its projection, which is 100%. So for 2009, any net income or any dollar above the 24 million, which is the floor earnout, would be valued at a certain multiple. In this case, it was 6 times here, and 4 times for 2010, and 2 times for 2011. So basically, the adjustment for 2009 was 27 less than 24, which is around 2.7 million, times 6 times, which is 16 million riyals. So the valuation, the post-money valuation, would go up from an initial 288 million to 304, and so on until the earnout expires in 2011. So we've reached here, we've come up from 288 post-money to 330, which means a pre-money valuation of 230, pretty much in line with the 247 that Dr. Ali was asking for, or was willing to settle for. So now we had 2 options to reward.
I have a question about this multiple.
Yeah.
I thought when you were exiting, your net income was more important for you, and I would assume the multiple for 2011 net income would be higher in that sense. Why are you giving more incentive to 2009?
You mean more incentive?
Yeah, I mean, it's 6
Why
times
lower
more, right?
Yeah. Why a lower multiple?
Yeah, why lower multiple in 2011 versus 2009?
Well, I mean, if you look at just two things, if you look at forward multiples of any company, they're always in a growing environment. They're always like lower than historical multiples, right? Just by the sheer game of math. Number one. Number two, the descending order might sound arbitrary now, but we basically, it is a bit arbitrary in the sense that, okay, we're taking the view of forward multiples are lower. Now, what should we give him every year to get back to that valuation gap? And we could have plugged very different numbers, to be very honest, but we're not going to give him something on the future based on something I gave him on the historical. So it has to be lower, especially if you have an earning expansion. So, and you're the buyer, right? So I'm not gonna, my starting point is going to be that. So he might ask me for higher, and we're going to find a midpoint type of settlement. But at that stage, I mean, there's no specific, I would say, scientific. But I mean, your comps were typically your forward earnings were also trading at lower multiples with similar growth type of profile.
The objective was to bridge or to get to 200%. So we had, as I mentioned, we had two options to reward Dr. Ali. So we either gave him back shares just to reflect our stake based on the new valuation, or we pay him back in cash. In the case of the share back option, so we had injected 100 million. Based on the new valuation of 304, our stake would be 32.7 as opposed to 34.7 initially. So in order to reflect that, we needed to give them back 101.9% of the company. So on and so forth. So our ending stake based on the new valuation would be 30.3%. Same for the cash payment. So in order to keep, the objective here was to keep your stake steady at 34.7. So based on the new valuation, the cash payments that needed to be made on a cash out basis, not injected into the company, and from Amwal's pocket, definitely not from the company, was for 2009, we had to pay back 5 million, 4 and 2 for 2010 and 2011 respectively. So we ended up paying 114 instead of 100 and owning the same stake, 34.7%.
Just one thing, you may ask in the share give back, why didn't you start with low? And then he could have asked, why don't you start with the low and I will give you back share because of underperformance. Now this is where you say, this is illegal, ownership is 9/10 of the law. I'd rather own the shares and give him back and not the opposite. I don't want to run after my shares. So let me be the referee, I'm going to be more rational than he is. I'm a financial investor. So we started by having the high ownership and diluting ourselves progressively, or not diluting, or giving back shares progressively. As opposed to, he could have said the opposite argument, say, give me back all the shares and I'll give you back if I underperform. Well, you know, the lawyers teach you some very few things, but some of them are insightful, and that's one of them. Sorry, go ahead.
Is this type of earn-out framework, have you tested it before?
We have tested it once and it worked pretty well. And the thing is that, you know, you can do all types of tricks. You can optimize his net income and try to cut on his marketing expense and so on and so forth. But you know, in an 80-20 type of rule, I mean, how much can he save? At the end, we're talking about big numbers here. He's doing 3x on his earnings within 3 years, and we needed to make sure that he gets there. So, just, I'm going to show you, I have like 3 minutes to go, just very, very briefly. I just want to show you the impact on the IRR between. So basically what happened here is all we did, really, is trading downside protection for a bit more upside, especially in the share give back. So you see like my IRR benefit from another 4.5–5% more in that case when you run the sensitivity on 70% of the budget, and so on and so forth. While here you might say, well, I'm a bit worse off in a specifically share give back plan. And in a cash one, you're actually always better off because actually the company is doing very well and you're still keeping your share. And you paid a very minimal amount. Now if he has taken Professor Gultekin's class, he might have told me 10 million tomorrow is worth 5 million today, and so on. So he could have been tricky if he was the son of a Wharton grad or something like that. I would have been more cautious in how I would have presented that. Yes?
The IRR in the cash payment case is not comparable, right? Because the time clock on the IRR starts at a different time.
That's what I was saying.
So, okay, so then, but don't you adjust like?
Oh yeah, this is adjusted.
It starts
This is a basically DCF based, I mean this is an IRR based on the cash timing as well, like here. So these are my outflow, this is 100 million today, my 5.8, my 5.2.
Shouldn't that start from 0 date? I mean, it's committed capital.
I don't know.
The way we used to do
Okay,
it.
if you have reserved for it, yes.
You'll have to, right? Because it's a deal you've committed. Shouldn't you reserve?
It's a good point. It's a good point.
That's only if it's a fund deployment, right? If the cash can come out of the company, then it can be looked at different because you don't have to reserve from it. So
No, but we had to come out with it from our pocket, and it was a cash out. So in that case,
Yeah, but
you're right.
you don't have to call it from day one. If
The
you-
thing
if
is
you're
that you don't
okay
have-
with-
yes.
yeah, you can call
Now
it
you-
later.
If it's contingent, you probably have to show it in your IRA. If it's contingent.
Well, yeah, it's a gray area, but we typically call on the dot.
Let's give Bonnie 1 minute to wrap up, and then we'll do the
Okay, just does that deal happen? No. Why? The market tanked, and you know what? When you get used in investment committee to 9x, and when the public market was at 15x, when the market tanks, the public market went down to 12 times earnings, which gives us really like a great, I would say, confidence and comfort in our approach, saying, okay, I would have never gotten a multiple arbitrage working against me here. But when you have market going down from 15 to 11 times earning, your investment committee doesn't want anything at 9x. They want something at 6x and 7x. That shows you exactly. I mean, when you get somebody used on a pricing discipline, and a certain discount vis-a-vis public markets, they're going to get used to it. And the last thing we wanted to do is go back to the gentleman that was making 30, 40% net income improvement year over year and tell them we're just going to go back lower and lower and lower, and he's going to lose face. And we had a relationship with the gentleman, and so we went back to the guy and said to him, Dr. Ali, you have a great company, you're growing extremely well, but that's not the right time to sell. And we want to keep you as partner, give us a couple of years or a year, and we'll talk again. But we're going to lowball you now because our investment committee would want that, and look at the public market. Now, for him, it didn't make sense because he said, I don't care about the public market. Look at my net income. But we're a private equity firm, and we take a public listing view. Professor Gultekin will give you all type of like sheets. We have all the graph on the valuation and so on, all the geeky stuff. But also, these are the right that we did require from him, which were a tag along, which was an IPO option in case he votes against it on the board because he promised that he would deliver it. We had the right to sell him at a certain pre-agreed price and so on. And all the set of reserved matter that you were asking about, of what are the typical things that you would ask veto right for, which relate to budget, to change of the capital structure, to new businesses, to M&A, and so on and so forth. So these are the typical right. As you notice, you don't find drag along, and because in this region people are very, I would say, when they've built something from scratch, they don't want to find themselves obligated to sell it to someone else just for you to make a return. They'd rather buy it themselves and probably sell their property. But you're not going to sell my grandfather's company, and it's not going to happen. So never ask for it. So I hope this gave you a bit of a blend of the region, private equity, and what we do. I hope you enjoyed it. I wish you luck. I know it's a tough graduating year, and if you need any information on the region, on earnout structures, ask Asad, not me. Thank you very much.